Picture this. You've spent 4 decades playing by the tax rules, socking money into every approved retirement account, and finally, you feel like you've earned the right to coast. Then a retired CPA, someone who once helped draft those very same client memos you followed like gospel, calls you up in a panic. His voice shakes as he describes opening a plain white envelope from the IRS and seeing a tax bill larger than the down payment on his first house, all because of one seemingly harmless Roth maneuver he'd copied from a YouTube hack video. He thought he was performing a clever little shuffle. Move after-tax dollars from his traditional IRA into a Roth, watch them grow tax-free, toast his smarts. But buried in the fine print was a single sentence, the pro-rata rule, that instantly turned his tax-free dream into fully taxable reality. Overnight, every dollar he'd ever deducted across every IRA he owned was dragged into the calculation, ballooning his income, jacking up his Medicare premiums, and even making his Social Security checks suddenly taxable. The worst part? He isn't alone. Boomers across the country are lining up for the same shortcut, blissfully unaware that one wrong step can trigger a cascade of penalties, surcharges, and surprise bills that haunt them years after the conversion is done. That's why, before you touch a single dime in your nest egg, we're breaking down the 7 silent Roth traps most retirees never see coming, straight from the CPA who learned the hard way. Stay with me, because the fee you save today could cost you tenfold tomorrow, and the scariest part is how easily it happens. On paper, the all-in-one Roth shuffle looks like a loophole so good it almost feels illegal. Slide the after-tax dollars you've already stashed in a traditional IRA straight into a Roth, shut the lid, and watch them grow forever tax-free. Influencers sell it like a magic disappearing act. Money goes in taxable, pops out untouchable. But they leave out the rule that makes the trick backfire for thousands every year. It's called pro-rata aggregation, and it's hiding in a single line of IRS Notice 2025. Here's how it turns a victory lap into a faceplant. Picture Linda, 68, who spent a weekend binge-watching early retirement hacks. She heard that if she moved her $8,000 of after-tax IRA contributions into a Roth, she could skip the conversion tax entirely. What her favorite guru neglected to mention was the $200,000 of deductible IRA money she'd built up in the same custodial account. The IRS doesn't care which dollars Linda thinks she's moving. It treats every conversion as a blended smoothie containing the exact same taxable ratio found across all her IRAs. Because 96% of her total balance had never been taxed, 96% of her tax-free shuffle instantly became ordinary income. In one click, Linda vaulted herself into the 32% bracket, torched her 0% capital gains window, and guaranteed a brutal Medicare surcharge 2 years later. Even worse, the move yanked almost her entire Social Security benefit into the taxable column, yet another domino she hadn't seen. Could she have dodged it? Absolutely. She could have rolled the pre-tax portion into an employer plan first, isolating the after-tax money before converting. But the broker's online form never hinted at that option, and her CPA only learned about the transaction after the 1099, or was already on its way to the IRS. Linda isn't unique. The pro-rata rule ambushes savers who assume after-tax means tax-free, and by the time the letter arrives, the damage is baked in. Math missteps are bad enough, but timing mistakes can be even deadlier. And the next trap proves the calendar can punish you harder than the calculator ever will. Time, not numbers, is the silent killer of Roth conversions, and its weapon of choice is the twin 5-year clocks that almost nobody remembers until it's too late. Most retirees have heard there's a 5-year rule, then shrug because they assume they crossed that line ages ago when they first opened a Roth. Wrong. The IRS actually runs 2 separate timers. One on every dollar you ever toss into a Roth through direct contributions, and another brand new timer on each individual conversion. Miss either countdown and the trapdoor swings open, dumping so-called tax-free earnings into the ordinary income bin, often with a 10% early distribution penalty, riding shotgun. Meet Frank, 70, who converted $150,000 on January 3rd, 2023, thinking he could pull cash in about 5 years. 18 months later, a roof leak forced him to dip in early, and that's when the nuance crushed him. Because Frank's conversion clock always rewinds to January 1st of the year, he converted. His 5-year window doesn't close until January 1st, 2028. His emergency withdrawal in mid-2024 meant the entire gain portion was instantly taxable, plus the penalty, even though he was well past the magical age 59 and a half. And the pain snowballed. The extra income shoved Frank's qualified dividends into a higher bracket and nudged one more Social Security dollar onto the taxable side, adding insult to injury in a single line item. Could he have avoided it? Yes, by designing smaller, laddered conversions or by tapping a taxable account first, but no one flagged the clock when he clicked convert. More stingingly, that extra income also set a 2-year time bomb that would jack up his Medicare premiums, proof that the calendar can hammer you long after the tax year closes. And that premium hike is only one of the hidden costs a Roth misstep can trigger, because the next landmine arrives courtesy of a government agency that isn't the IRS, yet wields an equally painful invoice. The real gut punch doesn't arrive from the IRS at all. It comes 2 years later when Social Security sends a thin gray letter announcing your new income-related monthly adjustment amount, better known as IRMA. That single page can swallow the entire tax savings you thought you scored with your Roth shuffle, and it all hinges on a $1 misstep. Take Maria and Ed, both 74, who converted $140,000 of pre-tax IRA money in late 2023, figuring the temporary tax bump was worth the future tax-free growth. What no one explained was that Medicare uses your modified adjusted gross income from 2 years earlier to price your Part B and Part D premiums. Their conversion shoved 2023 Magi just $900 above the first RMA line. So in 2025, the couple watched their standard Part B premium jump from $185 each to $259 each, plus an extra $18.80 per person for Part D, roughly $1,700 a year in surprise costs. Had they converted only $5,000 less, their premiums would have stayed in the lowest bracket. Kiplinger dubs this the $1 more rule because even a single excess dollar can trigger a surcharge of more than $1,000 a year, and the hit compounds as each bracket stacks on the next. Worse, IRMA tiers are cliffs, not slopes. Missed by pennies pay the full freight. That means capital gain harvesting, Roth conversions, even unexpected interest on a matured CD can catapult you over the edge without warning. Ed later joked that their tax-free plan became the most expensive free lunch they'd ever eaten. The accountant's postmortem was simple: ladder conversions in smaller bites, run a mock form 1040 before hitting submit, and keep taxable income at least $1,001 below each threshold, because Medicare's invoice arrives long after the ink has dried on your return. And paperwork errors inside employer plans can be even nastier, especially when a mega backdoor Roth is involved. Most people assume that once the money lands in their IRA or Roth, the paperwork is done. But one of the most devastating mistakes you can make happens after the transfer, when a single wrong checkbox turns your conversion into a costly boomerang. It's called a recharacterization slip-up, and it's a tax disaster hiding behind innocent-looking paperwork. The worst part? You may not even know it happened until months later when the IRS sends a notice you don't understand, and by then, fixing it might be impossible. That's what happened to Sheila, a 67-year-old retiree who followed all the right steps. She moved $12,000 from her traditional IRA to Roth, checked the boxes online, and assumed it was done. But the brokerage firm misinterpreted her entry and processed the action as a recharacterization, not a conversion. Instead of recognizing the move as a taxable Roth transfer, the system treated it like a reversal, bouncing the money right back to her traditional IRA. Then came the kicker. The IRS still taxed the income because the brokerage sent a 1099 are showing a Roth conversion, while Sheila's records reflected the funds being returned. That mismatch triggered both a tax bill and a red flag for audit. When she called to correct it, the custodian shrugged. Too late to amend now. She ended up paying tax on a conversion that never legally happened, and had to reconvert the funds the next year just to get them into the Roth as originally planned. Reddit threads and CPA forums are full of horror stories like hers. Incorrect distribution codes from sent too late or brokers who ignore updated instructions. Once the IRS gets the wrong signal, you're left cleaning up a tax mess that feels impossible to fix. Even something as minor as mislabeling a rollover as a contribution can throw your entire return into chaos. The lesson? Always double-check the confirmation statements, verify 1099 are codes, and track the exact dates and instructions. Because in the eyes of the IRS, intention doesn't matter, only paperwork does. And that brings us to a new twist in the Roth rules that few people are prepared for. One that starts out looking like a gift, but quickly turns into a ticking time bomb for anyone over 50. On the surface, Secure 2.0's new catch-up rule looks like a generous boost for older savers, finally allowing workers over 50 to stash even more into their retirement accounts. But buried deep in fine print is a brutal twist that could blindside high-income earners starting in 2026. If you make over $145,000, your catch-up contributions must go into a Roth account, no more pre-tax deduction. That sounds manageable, until you realize how many workplace plans aren't ready to handle this shift and how many participants are unknowingly setting themselves up for double taxation. Here's how it breaks you. Tom, a 59-year-old engineer earning $160,000, continued his habit of maxing out his 401k and adding the catch-up every year without thinking twice. His plan hadn't yet updated its payroll system to enforce the new Roth rule, and no one at HR raised a flag. In 2026, Tom contributed his $7,500 catch-up just like always, thinking it would lower his taxable income. But when the dust settled, he realized the plan still processed it as a pre-tax contribution, even though he no longer qualified. The IRS later flagged the issue and required the money to be reclassified as Roth, but by that time, Tom had already deducted it from his income, received a refund, and spent it. The fix? An amended return, possible penalties, and taxable income that now counted toward his Medicare IRA calculation. Even worse, because the plan wasn't fully Roth-enabled at the time, his catch-up funds had sat in limbo, collecting no earnings, no tax protection, and zero growth for nearly 6 months. According to Milliman and CBIZ updates, many plans across the country are scrambling to comply with the mandate, but gaps remain, and most participants won't realize the system is broken until it's too late. That means if you're over 50 and still working, the bonus contribution you think is helping might end up costing you in taxes, penalties, and lost time. It's a bureaucratic trap dressed as a benefit, and the final twist? Even after you retire, the smallest misstep, literally just $1, can unravel everything you work to protect. Most tax mistakes unfold slowly, but the final Roth trap can trigger with the quietest misstep imaginable, crossing a line by just $1. It's what financial planners call the cliff effect, and it's one of the most dangerous realities facing retirees who think they're playing it safe. Here's how it works. When you take even a single taxable dollar more than you planned, maybe from a Roth conversion, an RMD, a CD maturing at the wrong time, it can push your income just above key federal thresholds. And unlike gradual tax increases, these cliffs hit instantly and hard. Take George, 72, who carefully mapped out his income to stay in the 0% capital gains bracket. He harvested long-term gains, converted $10,000 from his IRA to Roth, and assumed he was well within limits. But one tiny dividend from an old brokerage account, just $24, pushed him a few dollars over the cap. That single bump meant $3,000 of previously tax-free gains were now taxable at 15%, and part of his Social Security income became exposed as well. Worse, it tipped him into a higher IRMAA bracket, raising his Medicare premiums for the next 2 years. Total damage? Over $2,600 from one unnoticed dividend payment. These income cliffs don't just affect capital gains and Medicare. They also reduce eligibility for premium tax credits, increase taxation of Social Security, and in some cases, even push Roth conversions into the dreaded 3.8% net investment income tax range. The IRS doesn't care that it was an accident or that you planned carefully. If your modified adjusted gross income crosses a line by even a single dollar, the consequences are automatic. That's why smart retirees use every tool available: qualified charitable distributions to reduce RMDs, tax loss harvesting to offset gains, and detailed income modeling to forecast cliff risks before they hit. Because once you trigger one of these hidden thresholds, there's no turning back. The Roth IRA may be one of the most powerful tools in retirement, but one wrong move, no matter how small, can turn it into an expensive miscalculation. The Roth IRA is often painted as the golden ticket of retirement planning: tax-free growth, no required distributions, and total control over when and how you access your money. But what most people never realize is that its very power can become a liability if used carelessly. The final and most deceptive trap isn't about a rule or a form. It's about timing, coordination, and how one Roth decision can quietly unravel the rest of your financial strategy without warning. Think of Janice, a 70-year-old widow who had been carefully living off a modest combination of Social Security and a taxable brokerage account. For years, she avoided touching her IRA altogether, hoping to leave it untouched or convert it slowly to a Roth to ease her future RMD burden. One year, her advisor suggested she convert $20,000 to Roth while rates are low. On paper, it made sense, but what neither of them noticed was that the Roth conversion pushed her income just over the threshold where 85% of her Social Security became taxable. That one decision added nearly $6,000 to her taxable income. Then, because the higher income was reported on her tax return, it pushed her capital gains from 0% to 15%. She also received an IRMA letter the next year, another $1,400 out the door. In total, her smart Roth move cost her more than $3,000 in additional taxes and fees, completely wiping out the long-term benefit of the conversion. The worst part? It was all avoidable. If she had coordinated her Roth move with some charitable giving or delayed a small gain from her brokerage account, she could have stayed below every trigger point. But no one walked her through the chain reaction. The Roth didn't betray her, poor planning did. And that's the silent danger. A single well-meaning Roth decision, made in isolation, can backfire when it isn't aligned with the rest of your financial picture. Because in retirement, every move echoes louder than you think. Looking back at the 7 traps we've just walked through, one thing becomes painfully clear. The Roth IRA is not the easy win so many retirees are led to believe. It's powerful, yes, but power without precision can be dangerous. Whether it's the overlooked pro-rata rule, the misunderstood 5-year clock, the IRMA cliffs, or the new Secure 2.0 changes, each of these pitfalls has the potential to turn a well-intentioned move into a costly financial setback. And the scariest part? These aren't rare mistakes. They're common. They happen quietly, often without warning, and usually to people who think they're doing everything right. That's the silent risk of Roth enthusiasm, when it's driven by headlines, not strategy. The retired CPA whose story started this journey didn't stumble because he was reckless. He stumbled because he followed the surface-level advice that gets repeated in articles, webinars, and financial YouTube videos without understanding how it applied to his full picture. That's the real takeaway. The Roth IRA can absolutely help you reduce your future tax burden, protect your Social Security from taxation, and grow your savings tax-free. But only if you handle it with the level of care it demands. There's no shortcut here. No plug-and-play solution. If you're serious about using the Roth as a long-term asset, then you have to go beyond the surface and start asking deeper questions. How will this affect my Medicare premiums? Will it trigger tax on my Social Security? Does my plan even support the kind of conversion I'm attempting? Before you act, pause, run the numbers. Talk to someone who understands the traps before you step into one. Because retirement isn't about making bold moves, it's about making smart ones. And sometimes the smartest move is the one that protects what you've already built. If this video opened your eyes to a rule or risk you hadn't considered, let us know in the comments below. And if you know someone who's planning a Roth move this year, send this their way. It might be the warning they need to avoid a painful, expensive surprise.